Yeah, so it's really interesting. If you look at the market for real estate mutual funds, you'll find that you have bond funds and you have equity funds, and they operate in two separate universes, which to us is a major inefficiency because relative value across the capital structure, changes on a daily basis. And so for us, we open up the menu of options from residential to commercial, from mortgage-backed securities all the way down to REITs to find the best relative value on any given day. And this flexibility is critical, not only because we can take advantage of changes in the market, but because we can create a more balanced portfolio that doesn't face the type of liquidity problems that a more concentrated bond fund tends to face. Yeah, so we expect interest rates to rise next year, and we position for this in a few ways. So on the bond side, we want to make sure that a majority of our bond positions are short duration and have floating rate coupons. And so as interest rates go higher, the bond coupons will also go higher. On the equity side, we want to make sure that a majority of our positions own underlying assets that will appreciate as interest rates rise. And so a good example of this is mortgage servicing rights, which are widely held by residential mortgage REITs. And servicing rights tend to appreciate in value as interest rates go up, because as interest rates go up, refinancing activity and prepayments fall, so the value of that servicing right goes higher. And so this is a good example of the type of overlooked value that we're constantly searching for when we make investments. Yeah, so this is a question that we do get a lot. And I would say it really can fit into any bucket for an investor, from fixed income to equities to real estate to alternatives. From a credit risk standpoint, I would say the portfolio looks most like a bond portfolio. And that's because in addition to our bond exposure, we are overweight residential mortgage REITs as opposed to REITs that own equity interests in actual properties. And so residential mortgage REITs own primarily portfolios of mortgage bonds and mortgage loans. And so we view that investment as a way to get bond exposure, but with better return potential. And so, big picture, I would say investors really need to kind of redefine their fixed income bucket to find other sources of return, given how low bond yields are in the market.